The Hidden History of How Civilization Asleep. 1.9. The Things You Already Trust. Acquired Inventory. Before we move on to the next stage of the argument, it is worth pausing to ask the reader a question they may have never been asked before. Why do you trust corporations you had never visited? Take a moment with this. You have almost certainly in your pocket or on your wrist or on your desk products manufactured by companies you have no personal connection with. Companies whose factories you will never see, whose executives you will never meet, whose internal operations are entirely opaque to you. You handed them money, they handed you a product. The transaction worked. You went on with your day. If you have any savings invested for retirement, the situation is even more remarkable. You have, in some sense, given money to companies whose names you may not even know, in countries you may have never visited, on the expectation that they will, decades from now, return to you a portion of profits earned over those intervening years. You have made a long-term financial commitment to strangers on a planetary scale, with the calm confidence that this is a normal thing to do. This level of trust between strangers, at this scale, across this much distance and time, is not natural. It is not something humans evolved to do. For most of human history, no one would have considered such an arrangement possible, let alone routine. The default human relationship to a distant stranger is suspicion. Trust at this scale is an artificial construction, built up over centuries through cumulative innovation in the technology of verifiability. The cornerstone of that construction is double-entry bookkeeping. Consider what each of the institutions you take for granted depends on. The joint stock company, that strange entity in which thousands of strangers pool their money to fund an enterprise none of them individually controls, depends on the ability to track, with mathematical precision, what each stranger contributed and what each stranger is owed. Without double-entry accounting, no joint stock company is possible. The Dutch East India Company, founded in 1602, was the first true joint stock corporation in modern form. Its structure preserved the accounting practices Pacioli had published a century earlier. Without those practices, the company would have collapsed in its first decade under the weight of unresolvable disputes about who owned what. The stock exchange, where shares of joint stock companies are bought and sold continuously by millions of strangers, depends on the same foundation. Every share traded is, in essence, a claim on a future flow of profits, and that claim can only be priced and exchanged if the underlying flows are tracked accurately. The first true stock exchange, in Amsterdam, opened in 1602, the same year as the Dutch East India Company. The two innovations were the same innovation, viewed from different angles. The company was the entity. The exchange was its market. Both were possible only because the accounting subject could support them. The Mo-Nian-Chao National Corporation, that even stranger entity, which operates simultaneously in dozens of countries under different legal systems, depends on something more demanding still. It depends on the ability to consolidate financial activities across jurisdictions, currencies, language regimes, into a single coherent picture of the firm's overall position. This consolidation is not philosophically possible without a common accounting language that all the firm's offices can speak. That common language, despite local variation, is the descendant of what Pacioli wrote down in 1494. Modern taxation, the entire mechanism by which states fund themselves through claims on the income and transactions of their citizens, depends on the same foundation. The government cannot levy an income tax on a population that does not keep records of its income. A government cannot levy a value-added tax on transactions that are not double-entered into seller and buyer accounts. The administrative apparatus of the modern fiscal state, which today processes the financial activity of billions of people, would be impossible without the accounting infrastructure that quietly absorbed itself into European cognition over centuries. The list could be extended. Insurance, with its actuarial pooling of risks across thousands of strangers. Banking, with its creation of money against verified collateral. Credit cards, with their networks of trust between merchants and unknown buyers. Pension funds, the mortgages, the bond markets. Each of these institutions, on which the modern economy depends, presupposes a population that is comfortable with the basic premises of double-entry thinking. We do not notice this dependency because the dependency has become invisible, the water in which the fish swims. We do not stop to wonder, when we tap a card to pay for groceries, what cognitive infrastructure makes that tap possible, that we simply tap and move on. But the tap is the tip of an iceberg, whose underwater bulk is the centuries-long absorption of mathematical accounting into the everyday minds of millions of Europeans, and from there into the global infrastructure of trust we now rely on without thinking. The reverse case is instructive. When other civilizations encountered modern joint stock companies, stock exchanges, multinational firms, and tax systems through European trade and later through colonial imposition, they often adopted the formal structures while continuing to operate beneath the surface on older trust mechanisms. The result, in many cases, was a kind of hollowness. The institutions existed on paper. Their actual operation depended heavily on personal relationships, family ties, regional loyalties, and other pre-modern bonds that the imported institution were supposed to supersede. This is why, in many late developing economies, the stock exchange operates with persistent insider trading. The Monishinarene subsidiary is undermined by family-based corruption. The tax authority chronically fails to collect what is owed, and the joint stock corporation is repeatedly used as a vehicle for fraud against minority shareholders. These are not failures of effort or virtue. They are the predictable consequences of trying to run institutions that presuppose a particular cognitive substrate in populations where that substrate has not been built.